Hello, Michelle. 3 weeks into the year, market sentiment is characterized by optimism. My question for you is, how does that affect private credit supply-demand dynamics, as well as deal terms?
Like other markets, January tends to be a seasonal slow point for the private credit market. So much of the deal activity we're currently seeing falls into two categories. One is related to deal flow that slipped from Q4 of 24 to Q1 of 25. And then the second is mostly just refocusing on refilling the pipeline post the holiday season. So the start to 25 really looks very similar to what we experienced in 2024. While overall we saw the supply-demand imbalance continue, which led to M&A activity remaining below historical levels, we did start to see a material increase in LBO activity in 2024. We participate in the lower end of the middle market, companies with between $5 and $50 million of EBITDA, averaging about 20 to 25 million. Much of the M&A activity in this part of the market is driven by founder entrepreneurs selling into private equity for the first time versus sponsor-to-sponsor M&A activity, which drives a large portion of the broader market's M&A activity. The moderate decline in interest rates in 2024 was enough to unlock deal flow, leading to strong deployment. At the same time, the broader market experienced spread compressions in the first half of 2024 due to an increase in refinance activity. That spread compression, coupled with a search for quality credit, has resulted in some spread compression in the lower end of the middle market. Spreads currently sit at around SOFR 500 to 550, but overall yields remain elevated given higher base rates. Otherwise, terms remain relatively unchanged. Leverage, loan-to-value, financial covenants remain more robust than the broader market.
Let's shift gear to talk about credit fundamentals. Are companies in solid shape, and what's your outlook for the rest of 2025?
Direct lending fundamentals remain stable to improving in Q4 2024. Borrowers continue to demonstrate both revenue and EBITDA growth across most sectors, including consumer. At the same time, the gap between that revenue and EBITDA growth has tightened, and for the last several quarters, margin growth has continued to outpace revenue growth. Finally, valuations continue to increase, driven by earnings expansion. All of this indicates stable to improving company fundamentals and general economic stability. So what does this mean for 2025? Right now, we would generally expect to see these same trends continue into 2025, driven by lower unemployment, interest rates, energy prices, et cetera.
Well, thank you very much for your time and thoughts today, Michelle. I look forward to speaking to you next time.
Thank you.